Well, hey there, everyone. Happy Thursday, June 25th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of overcast, beautiful June day here in Redmond, Washington. Hope you guys are all doing well. We're here at Stock Charts HQ doing some things this afternoon and seemed like a good idea to just hang here and do the show live from the studio here. Interesting day today. I mean, a choppy, sloppy, sideways day. It was interesting with the news flow going into today, sort of split between, Micron's earnings, which are obviously remarkably strong, the economic data, which was relatively strong, but inflation, reading higher and higher. No surprise there, I would say. And at the end of the day, how does this all mix together? It mixed together with the S&P 500 literally going flat. As much as we think about macro forces as a technical analyst, I've learned to look at the charts and use that to reflect, the most important conditions I personally want to be aware of. And we have had this situation where the Magnificent Seven stocks as a basket are doing remarkably poorly in the month of June. And we can't, we have to recognize we can't overstate the importance of those, that small number of huge stocks have an outsized impact on our benchmark. So even if every Train Technologies and Morgan Stanley and whatever other bank and industrial and healthcare name you want to come up with that is breaking out, all of those don't even come close to the impact of Apple being down 6% today. So you've got some of those Magnificent Seven names in arguably a free fall right now. And while Micron is making new highs, and while a lot of semiconductors are doing well, and SanDisk was up over 20% today, the biggest names with the biggest weights, the big conglomerates, are not doing particularly well. And so it's a very interesting market, very interesting, unique set of conditions that we're experiencing here. And again, I think the lesson for me as we go is just the importance of recognizing the charts. I think investors get into trouble when you think something's happening in the Middle East, so these are the stocks that should do well, right? This news headline I read means all these other things should happen. That's where investors often get very frustrated and often get absolutely crushed when the market moves in surprising ways, which it often does. So by looking at charts, we're not sort of predicting the reaction to impact. We're measuring the reaction. We are measuring whether investors are nervous or desperate or excited or optimistic or pessimistic. All that's going to be on the charts if we have a good, consistent process of evaluating them. I hope for you, this show and what we do with market misbehavior is part of your own process of understanding market conditions and keeping aware. We'll do our best to point you in the right direction as always. All right. Yeah, those of you tuning in live on Facebook, LinkedIn, YouTube, and X, welcome. You can use the comment section as we live stream on any of those platforms. Just wherever you can drop a comment, I can see it here. And we'll try to take some questions during the live broadcast. If you're watching the show later on YouTube, thanks for checking it out. Use the comment section on our YouTube channel to ask questions. We're planning an all mailbag episode on Friday, tomorrow. We'd love to answer one of your questions on the air. By the way, we've got the red, white, and blue dress shirt on today. Go USA. I will tell you one of the side stories to follow. If you want to know what's important in the Keller household, Christian Roldan is a midfielder for the Seattle Sounders, our hometown team. He is on the men's team. He has not seen any playing time yet, and we are hoping he'll get on the pitch tonight. He's fighting an injury, so I don't know if it's going to happen, but we would be thrilled if he does. So know the Kellers will be cheering for sure if we see Roldan on the field. Having said that, let's get to the charts. Okay, I've got a blank blue screen, so let me fix that. So there we go. Hopefully you can see my chart now. Here we go. So here is the choppy sideways day. And I mean, really, we opened higher, we traded lower, and then that opening range in the first 30 minutes was pretty much it. We never got out of that first 30 minutes. And that tells you that is a consolidation day if I've ever seen one. And so we literally just traded above and below yesterday's close. At the end of the day, we finished, less than a point away from that on the S&P 500. So, for all intents and purposes, unchanged. It's an unch day for the S&P 500. The Dow finishing slightly higher. And what was interesting there as a observation today is about an hour into trading, the Dow was up pretty significantly. It was actually having a really good morning. And while the S&P had chopped down, while the NASDAQ was down, it was like the Dow was definitely up. But as the day progressed, it was almost like the weight in those big growthy names started to drag down the Dow. And at the end, the Dow was barely above water, up, less than 1/4%. The NASDAQ composite's been pretty much the entire day below zero, down about 0.5% into the close. Mid caps and small caps did much better. The small cap S&P 600, which, as we shared on yesterday's show, with a brilliant chart showing the performance of the major U.S. indexes year to date, small caps have been outperforming large. And as of this week, the S&P 600, the Russell 2000, both small cap indexes have outperformed the Nasdaq 100 year to date. And so that's been a story for a while, and it just continues to be the reality here. So while the benchmarks were choppy and sloppy and essentially unchanged through the remainder of the day, the VIX did move slightly higher. We're not above 20, although we did trade right up to that 20 level in the first 30 minutes of trading. We finished just below 19. So by our reading, volatility is still constructive. The VIX is still below 20. That is a low volatility environment. Anything above 20, we will let you know if and when we see that. Probably when, not if. But at some point, volatility is going to give a red flag. I'm going to be there watching that chart when it happens, and I will let you know. All right, checking in on some of the other asset classes. Rates were sort of mixed today and generally not too much of a move. Through the course of the day, they ended up, finishing relatively flat. So no real change to long bond yields, 10-year yield, 5-year yield. The 10-year point is just below 4.4%. The long bonds around 4.85. If you look at the chart of the 10-year, I mean, it certainly looks like we are pulling back this week. We've seen a couple days now of rotating lower. I did keep that chart just to reflect on this continued downward push in the 10-year Treasury yield. That often has a lot of implications for a lot of different things. But, again, anytime you see rates coming down or we see rates in a big move, you want to think about how that impacts companies and consumers. Just think, who needs to borrow money for something, right? You as an individual need to borrow money to buy a car, borrow money to buy a house, which is why lower rates are kind of good for those types of businesses, because consumers are it's less expensive and they can buy more. What else would be good? Company, right? So small cap companies that have to borrow a lot of money, lower rates, if they're early in their growth trajectory, lower rates means most likely lower borrowing costs for them. And if you're borrowing a ton early on, that can make a big difference as well. So usually good for small caps, usually good for home builders. Not as good, lower rates, not as good for banks, which are, making money on the steepness of the yield curve, essentially. So yield curve is flattening. That's generally a headwind for, things like regional banks and stuff like that. TLT essentially flat today, opened quite high, similar to the Dow. The Dow and the TLT chart. TLT are Treasury bonds, Treasury bond prices. The Dow, of course, kind of, big, listed equities, and they had a very similar trajectory today. Big, strong open, and then drifting lower through the course of the day. The dollar has been pushing higher. It did actually pull back slightly on the UUP, just down about a nickel from yesterday's close. All right, looking at the DBC, this is a commodity ETF, positive. And as you can see, all of the commodity prices tracked here on the stock charts platform in the green going into the close. That's gold and silver actually going higher. Gold back above 4,000 an ounce. That was after closing below 4,000 an ounce on yesterday's session. Silver having a slight bounce higher as well. Copper prices up. Crude oil and Brent crude both in the positive. Natural gas, gasoline futures, even the soft commodities like soy and corn, all moving upwards. So, I mean, arguably these charts are still pretty challenged. The chart of gold is still not a great chart. Arguably, it's actually quite a bad chart, below trend lines, below moving averages. But at times like these, I think it's helpful to reflect on what would the chart of gold do for you to think, okay, wow, that's a great chart. And I don't think we're there yet, but we'll talk about that together as we reflect on that one. All the cryptocurrencies in the red today. Bitcoin down 2.5%. Ether down almost 4%. Bitcoin back below 60,000, which we traded below yesterday. Today, we're actually currently trading below, right around 59,500. Chart of Bitcoin went from interesting and encouraging to very not good as we break below 60,000. Bitcoin below 60,000 is not a good chart. I think we have to reassess and wait for some sort of sign of accumulator on that particular chart. All right, looking at the bread. So while it felt like kind of a risk-off day in a lot of ways, and certainly some of the bigger names were struggling, the out of the 11 S&P sectors, 7 of them were actually in the green today, and industrials were up big, up 2.2% for the XLI. Healthcare was number 2, up 1.5%. Materials up 1.33%. On the downside, 4 of the sectors were down. Consumer discretionary, the worst performer, down 1.5%. Amazon looks like absolute garbage this week, and that is certainly dragging down the XLI. Communication services, the XLC, down 0.9%. Financials and consumer staples, both down about 0.5% today. The breadth conditions actually look pretty good. It depends on what area of the market you're looking. The NASDAQ breadth was not particularly strong today. But if you look at the New York Composite Index, 56% advancers to 42% decliners. When you get down to the S&P indexes, better and better. And the small cap breadth, which has pretty often been the best, remains the best today, about a 2-to-1 ratio of advancers versus decliners. So what's so interesting is as the S&P was flat, a bunch of stocks went up. As a matter of fact, a bunch of stocks have made new 52-week highs this week. And so there's a big disconnect between what the benchmark is telling you and what's happening with these the individual names that comprise those indexes. At the end of the day, it often comes down to the calculation of these benchmarks, and that's kind of what we're seeing here. All right. Wanted to just highlight our market trend model, which we update formally every Friday after the close. It's a weekly trend model. This is something that is the beginning of every weekly report for my premium members. We start with the market trend model. It's the main way that I take something like the S&P and just define the trend on 3 different time frames. Stock Charts pretty awesomely has a widget you can put on your dashboard that tracks every day. It updates these for intra-week signals. And if today was Friday's close, our short-term model would turn back negative, and that could end up being a pretty important indication. We did turn negative a couple weeks ago, just for like 1 week, and then it came back positive. So enough distribution in the short term that it looks likely that we're going to have a downturn there in the short-term model. I don't lock it in until Friday after the close, though. So if stocks rally big on Friday for some reason, that could change between now and the end of the week. Looking at the 9 Morningstar style boxes, I mean, again, small cap has been the strength. The quality, the juice has been small caps. That's been the case for quite some time now, and today, no different. Small cap growth was up 1.4% versus large cap growth essentially flat. Small cap value up 1.1% today. Large cap value down slightly. So there's the story today was not growth versus value. It was small over large. I would say generally that's the theme I would take away. I don't know what to call this list of stocks. The lag 7 seems too easy, but that's a pretty good one. I might actually change the title of this chart list to that, but I'm afraid if I do that, that might be the bottom. So we'll see. But it's funny that at the bottom we have the mama stocks: Meta, Amazon, Microsoft, and Apple, all getting absolutely crushed today. And none of those charts have been good for a while. And I think that's kind of an important, if not the most important theme to know, right? There's definitely been a shift in leadership. There was a point not too long ago where it felt like these stocks were going to go up forever. They are not. And what's interesting is we are making the same argument for charts like Micron and others, like but this is the thing, though. This is different. These are going to keep going up forever. If there is one thing I am certain of, it's that charts like Micron will not go up forever. They will pull back. They will correct. Even if 10 years from now they're up a lot more than they are, it's not a straight line. And so I'm recognizing, I think there's a lesson to be learned from this basket of stocks that people considered impervious not too long ago as being kind of the future. And again, they will be in a lot of different ways, but in terms of are they a good stock to own today, I would argue really not, right? I mean, these are stocks that are underperforming and doing it pretty handily here and pretty clearly when you look at the charts. So having said that, Tesla, the best performer, and it was down slightly today. So the quality is not in this basket. I'm probably going to have to add Micron into this list at some point. I was trying to limit the number of semiconductors I put in, but it's the other semiconductors that are now starting to be more magnificent. So we'll maybe make some rotations there. All right. As a reminder, we are live streaming to Facebook, LinkedIn, YouTube, and X. I appreciate many of you joining us live. Always a pleasure to look at charts with all of you. I welcome your questions and your comments as we go. We'll try to address some of those questions through the course of our discussion today. Any of the questions we don't get to, we will put in our mailbag. And if you're watching the replay later on our YouTube channel, thanks for checking it out. Use the comment section there to put questions, and then we'll hopefully get your questions answered in our mailbag episode on Friday. Yeah, I tell you what. Thanks for pointing out Amazon. The when you initially see a rollover in some of the Magnificent Seven names, it starts out like Alphabet comes on. It starts out like, okay, it's no longer going up, but it's not a bad chart. It's still an okay chart. Charts like Amazon getting to their 200-day, failing to hold the 200-day, which stocks like Meta and Microsoft did a while ago. When that starts to happen, it's like you can't ignore the fact that this is something significant happening, right? This is no longer a good chart, and a great chart becomes a good chart, and a good chart becomes an okay chart. An okay chart often becomes a not so okay chart. And unfortunately, I see a number of these are kind of rotating to the not so okay bucket is what I would say. All right, here, let's check out the heat map and see what's going on. You'll probably note what I'm noting, which is I'm immediately drawn to big boxes that are in bright red, because that usually means there's a problem. And when I say there's a problem, obviously with the there's an issue with Apple right now, right? With the chart is going down, but it's also a huge issue for the benchmark, right? That's an issue for the S&P because it's a huge weight. It's an issue for the NASDAQ 100 because it's an even bigger weight. It's an issue for the XLK because it's the second largest name in a bunch of big names. So stocks like that are large, excessively large market cap, down big, is going to weigh on the benchmark pretty significantly. And so Caterpillar and Deere and Eaton just having these brilliant moves today don't even touch the impact of one stock like Apple being down to the degree that it has been. So I would say the down moves in a lot of these big names are very noticeable. Charts like Palantir, I continue to think as important cautionary tales. And again, I don't mean to always be negative about charts like this. I think there are times to own a Palantir, and there were certainly times when this is arguably one of the best charts you could identify in 2025. Right, some periods there was like, I don't know if I could find a better chart than that right now. But it is not a better chart now, right? There's so many things that have changed. And if you're looking for a way to upgrade your technical toolkit, I would encourage you to look back at charts like Palantir, stocks that were in strong uptrends and then rotated to clear downtrends, right? A lot of things happened on the chart from this point to this point, and thinking about what signals happen. When did the momentum shift? When did we break moving averages? When did we stop making higher highs? When did we start making lower lows? When could I see on the chart that we had rotated from a clear period of accumulation to a clear period of distribution? I think that's a very important set of thoughts to do. And, as much as you want to think about that going forward, you learn a ton from looking backwards. That's why we talk about keeping a trading journal. That's why we encourage you to set time at the end of the quarter, at the end of the year, to go back and actually review some of your successes and some of your misses to see what you can learn from, especially the misses. And I would say on a chart like Palantir, the deterioration in the relative performance, that bottom panel, is probably the most important of all, right? If we consistently own names where the relative strength is going up, we're going to probably outperform the S&P. If we consistently own names where the relative strength is going down, we're going to consistently underperform the S&P. That's how the math works when you own stocks where the relative strength is going down versus going up. Tom Bowley, who's come up in the chat today a couple of times, who I respect and have known for a number of years, would back me up on this, that relative strength is absolutely crucial. So, regularly reviewing charts that you own in your portfolio and making sure you don't own things where the relative strength is really starting to deteriorate. I think that's an important, a very important regular routine to go through. All right, now outside of those big names in technology, there are a lot of things up big. And of course, Micron's earnings were pretty solid yesterday. We can see that a lot of the semiconductors, Applied Materials, LRCX, KLAC, up pretty good. The storage names, which had pulled back yesterday, pretty good, having a nice bounce. STX is holding $1,000 a share, which I think is pretty important. You can see generally some of the software names probably struggling more than others. So I'm looking particular at like ServiceNow, Workday. These have not been good charts for quite some time, so I don't think it's a real surprise that they're not good today, but just certainly something to note. Other areas of the market struggling today, certainly consumer. Amazon, the biggest name in the XLY, down 3% today. We did grab that chart just to reflect on its inability to hold key moving average support. TJX is an important one to think about. This one actually went down quite significantly today, down about 6%. This is after making a new all-time high, topping out around 170 just about 2 weeks ago. Today was a big pullback down below the 50-day moving average. So I would say at the very least, uptrend in question, right? And sometimes it's as simple as drawing a trend line like this one. And, especially when you have something that's just going up a lot, right? Just like, all right, draw a trend line. And not that this is your main trading strategy, but just recognizing when those trend lines are broken can be a great wake-up call to say, okay, something's different, something's obviously shifting. We'll see if we get follow through tomorrow, but I would say for now, that's a concerning breakdown in what has been one of the few really strong charts in the consumer discretionary sector. Elsewhere, big box retailers in the consumer staple sector, that is, all having a tough day. And financials weren't horrible, but just not particularly good. And you can see a number of stocks that are pulling back quite a bit today. A group that stands out to me is sort of this, I think of it now as like the exchanges, market data kind of group, ICE, CME, kind of MSCI, NASDAQ, all down fairly significantly today. So if those are all bad, was there anything that was good? There absolutely was. And that's what, if there's something that's encouraging about this market, I think it's the fact that I'm still not struggling to find charts that actually look remarkably good. And so what you have to remember is in this particular situation, while the benchmarks are struggling and while the benchmarks, I would say, look questionable at this point in some ways, we've certainly seen a stall out at the very least in the uptrend. There are individual stocks that are outperforming and doing it quite handily. And I would say the two sectors that stand out besides technology, which is where, as we highlighted, semiconductors in particular looking remarkably good, as are the storage names, would be industrials, where you're seeing a bunch of stocks that were up today. I think I grabbed TT just to show a stock making a new breakout day, and then healthcare, right? And we've been talking about names like AbbVie and charts like Merck. I mean, Merck is just breaking out of a multi-month base today. So again, the moves are out there. And what's great about a benchmark that's struggling is breakout names that are not struggling all of a sudden give you the opportunity to outperform pretty well. All right, we're going to go through some of those charts and talk a little bit more about some other items as well. But I do want to, hold on a second. I completely missed the link that I meant to have up here. But I want to give a quick shout out to my friends at Koifin. There we go. Thanks, as always, to my friends at Koifin. They actually have some really fantastic capabilities built into their platform. Koifin is a financial analysis. It's a market data platform. It is designed for financial advisors and for individual investors as well. They do a really good job of giving you presentation-ready reports if you're working with clients. If you're just working on your own portfolio, they also have some fantastic portfolio analytics. And if you've never used a system that has good portfolio visualization tools, you're going to be pretty impressed. It allows you to break down all of your holdings, to think about exposure if you own things like ETFs, to recognize where the opportunities have been, where they've come from, what's helped your performance, what's hurt your performance. I've mentioned a number of times, a number of you have mentioned in the chat, the Super Bowly stock picking exercise that I participated in at the beginning of June. I'm actually tracking the performance of all of our portfolios in Koifin because it's a great way to compare relative performance of different baskets of stocks. You can find more information at marketmisbehavior.com/Koifin, Koyfin. They're offering our viewers 20% off your first a new account, by the way. So I'd encourage you to check it out. And again, if you're an advisor, strongly suggest you check it out because they have some really good capabilities of linking to client portfolios, creating presentation-ready reports, really giving you tools you need, I think, to enrich your relationships with clients. So marketmisbehavior.com/Koifin is the place to find more info about their platform. I want to thank the folks at Koifin for being longtime supporters of Market Misbehavior. All right, the daily chart of the S&P looks like this. Is it a head and shoulders top? Just to get ahead of a question. Actually, I got that question on the show yesterday and I didn't get to it. And so, is it a head and shoulders top? I mean, the answer is no, it's not an ideal one. If you want to kind of ignore some of the nuances and some of the specifics of the head and shoulders top, yeah, you could probably call it that. I have this blue line of support, what I call the line in the sand. And the reason why I have it drawn that way is because I'm not considering this a head and shoulders pattern. I'm just considering it a level of support. And I would say 73.40 stood out to me right here, sort of mid-May, because it seemed like that was the new higher low to pay attention to. We pulled back to that level a couple weeks ago and then had a couple days pushing below it, but then always kind of pushed back above it. And now, after what looks like an exhaustion gap here, we come back, and this week we are just bouncing one day after another off of that 73.40 level. When you have a level of support like this, it's like every time you test it, you further confirm the importance of that level, right? That's just validating that the market's recognizing this is a key level of support, which I think is encouraging as long as it holds. The problem is when it finally breaks, you're out of support, and then you have to start looking at further deterioration. So the way that I read a chart like this, current support, active support being tested this week at 73.40. If we would have a valid breakdown below that level, 71.20 would be a reasonable downside objective. That would be about halfway between the 50 and 200-day moving averages and would represent a 38.2% retracement of the way down. Break below 73.40. I mean, that's going to start to feel a lot worse than it probably is. I mean, it's still not that bad of a breakdown, and we're still well above the 200-day. But just because we've been in a pretty good uptrend for a couple months, we haven't had a big drawdown in a while. Since March, that's where it could feel pretty rough. Keep an eye on the momentum as well, as always, right? RSI below 40 is usually not a pretty good thing. For now, it's holding. All right, the VIX, right? The VIX, once again, trading at or near 20 before closing back below it. So the fact that the VIX is not breaking above 20, I would consider a fairly encouraging sign, right? VIX above 20 is a tornado siren telling you, volatility is spiking, which means investors are getting nervous, which means plan for excessive volatility, which usually means some sort of downturn, right? A pullback, a correction, something like that. For now, the VIX at 20 level is still holding, and I would say that's an encouraging sign. We spiked above the 20 level back in June. Before that, we spiked above there in February. The June spike ended up being just about a 1 week pullback. The February spike ended up being about a 6 week drawdown into a major low at the end of March. Which one of those is going to come? That's not what the VIX is designed to tell you. It's just designed to tell you that the volatility is similar to previous corrective moves. So something to keep an eye on. I do see some great questions, by the way, so keep them coming, because any that we don't get to, we will put them in our mailbag. But I'm really appreciating some of the thoughtful questions so far. All right. Breadth overall has been pretty good. The advanced decline lines are, I mean, at various stages of breaking out, it appears like to me. Not quite. I mean, not quite blowing out to new highs, but getting close. There's more and more stocks this week above their 50-day moving average and above their 200-day, and it's still about 2 out of every 3 S&P 500 members. So while the benchmarks are flat to slightly down, the breadth is actually starting to improve, which feels counterintuitive, but that's the nature of our top-heavy benchmarks. Our benchmarks are overweighted to the mega cap growth stocks, many of which are struggling in the month of June. As a result, you have the benchmarks kind of rolling over, but you have the breadth starting to improve here. So strong breadth in this particular situation means lots of great opportunities to outperform, because it tells you plenty of stocks are still doing fine, even though the benchmarks are not. And one of the best ways to outperform is own things that are going up when the benchmarks are not, right? That is the secret sauce behind most active managers doing well. It's getting defensive. It's still recognizing good opportunities, especially during periods of market weakness. It's really hard to outperform in a bull market. It's way easier to outperform in a down market because the things that are breaking out are so clear and they stand out, right? And so that's where I think, ideally it's a good situation for stock picking, which I think is never a bad thing. All right, here's the stocks making new 52-week highs on the New York Stock Exchange, and then the bottom panel in the S&P 500. You can see today, 12% of the S&P 500 members made a new 52-week high today. I'll say that again. Over 10% of the S&P members made a new 52-week high today. That's a decent number. That's actually the highest reading we've seen since February. So we're seeing plenty of stocks going up, and it's those charts like Eli Lilly that we've highlighted, or Merck, right? I mean, sort of breaking out above resistance. They're out there, right? So there are good charts out there. This is a really good time to have scans, to have alerts, to just be ready to identify those moves. All right. Sorry, I'm loving these questions. All right. This is the AAII survey, Thursday's sentiment day. A lot of the weekly sentiment data comes out on Wednesday and Thursday. So this is a good day of the week to kind of review sentiment indicators. AAII survey kind of continuing to rotate more bullish. We're up to 45% bulls. The last time we were this high was back in mid-April. Before that, you have to go back to January. Anything above 50%, I think of as a little too bullish. That's usually either we're in a raging bull market or people are way too excited about market conditions. We're seeing a big upgrade in optimism this week. And so I think, we're not quite to the extreme bullish level, but we are getting close there. This is the first week out of the last 6 weeks that bulls have outnumbered bears. And I think that's a shift to keep a wary eye on. The name exposure index is also getting dangerously close to our contrarian bearish reading, right? This is the name exposure index. It's a weekly survey of money managers, right? People that manage other people's capital. And currently the average is 99% exposure to equities, right? So this is asking for their percent exposure. So you figure the average is around 75, 80% or so, going back through a deep history of this indicator. 99% is way above average. Anything above 100%, I start to think about contrarian sell indications, right? When the respondents are too bullish, that usually means we're toward the end of whatever phase we were leading into. So we're pretty close to the level where I think the name exposure index starts to not look too good anymore. All right, the 10-year Treasury yield continued to move down a little bit. It wasn't too bad. It was actually down a lot more earlier in the day as bonds rallied slightly, but it's back below the 50-day moving average. Basically, since mid-May, rates have been trending downwards. And so what that means is there's clearly been a change of sorts between the end of February, beginning of or mid-May, and now where we're at today. And it's not lost on me that April and May, as rates were going higher, stocks are actually doing remarkably well. And here in June, as rates are rotating lower, stocks are not doing nearly as good anymore. So bonds and stocks actually diverging a little bit. Bonds holding up while rates are coming down, and while stocks are starting to show some internal weakness. Chart of gold is still not good, and even though gold was up today, I mean that's all that was, right, on the GLD compared to this big long-term downtrend. So a day like today, like on the surface, it seems all good news. Gold and silver are up. I mean, they were up the tiniest bit and still in such an obvious downtrend over a period of time. So reviewing regularly a chart like this for me is a great reminder to just not get too caught up into one day's move. Think about what today's move means within the longer term trend. And I would say for now, gold is still going down until it isn't. If there's anything to be slightly encouraged about on the chart of gold, the fact that we're oversold again, we actually came out of that oversold region today, but a bit of a bullish divergence here with new lows marked by higher lows and momentum. Still not enough for me to get too excited about adding to a gold position, but something I'm certainly watching here. Crude oil, I switched this to a candle chart earlier because it looked like we were going to get one of those bullish maybe a bullish engulfing pattern, but at least what's called a bullish piercing line, but we didn't quite do it. So why is this not a bullish piercing line? Here's your candle education for the day. A bullish piercing line would have a big down day, a lower open, but then this day two needs to close at least halfway through the real body of day one. And as you can see, it didn't quite do it, right? It got up toward that halfway point, and at one point it was above it, but by the close, we're actually back below the midpoint. So you can't call it any sort of bullish candle reversal, but for what it's worth, it's an up day, so that's good. Crude oil is still oversold. I do still have a contrarian position betting on crude oil and energy stocks, given the weakness that we've observed here. Hasn't been particularly great yet, but I'm still holding it to see what happens. RSI below 30, certainly a development to keep an eye on there. Bitcoin is actually very close to being oversold again. Earlier in the day, it actually was oversold, but it's actually lightened up as the day is getting near its 24-hour close. We're currently around 59,800. This is down quite a bit from 82,000, which is where we were about 6 weeks ago. So we're seeing quite a bit of a downturn in Bitcoin. This rally off of 60,000 looked really encouraging, but now we're back to those lows. And if we get a valid break below 60,000, I think that's a confirmed downtrend in cryptos, particularly in Bitcoin. SpaceX, I mean, no change here. So basically, we've round tripped from the IPO, the first day of trading, up to 225, back down to the open, and here we remain. So not a lot of excitement here for the for SpaceX shareholders. I wouldn't be surprised if this goes down further, but I wouldn't be surprised if something else happens. For now, as a technical analyst, one thing that we can establish is that 150 seems like a pretty clear floor in this market, just in the first week and a half of trading, right? And so that level of support is going to be pretty crucial. If we would break that, the IPO price is often an anchor price that many will tune into. So break below 150, I would say 135, sort of as best of a downside objective as I'd feel comfortable making, given the limited data that we have on the chart of SpaceX. I personally don't play IPOs, and I decided that a long time ago when I saw a lot of IPOs that seemed really good on day one, and then by day 10, they were absolute disasters. And I'll wait until there's more data and I can analyze a trend. For now, not great. All right, the mama stocks, the mama please help because our charts are so bad stocks. Amazon is one of those. That's one of the A's, and Apple's the other one. Today's drop takes us below the 200-day moving average. That was after that doji candle we mentioned yesterday. You might call it an inverted hammer. Maybe you'd call yesterday gravestone doji, but in either case, it did not work particularly well because today was down yet again. Amazon down 3%. That takes us below the 200-day. That takes us below the 61.8% retracement level. That's all bad. Unless we can recover that tomorrow, this seems like a valid breakdown. The 200-day moving average is the new level that I would watch. But as this has been happening, well, look at the relative strength, right? This is why we focus on relative strength. And generally, buying things with a relative strength is negative just has not been a good place. I felt optimistic about. Apple is one of the others, a gap down here as well. Note the gaps in a lot of these names like Apple and Amazon. We're not quite below the 200-day, but we're getting there. The last time Apple tested the 200-day was here in March and April. It held beautifully and then rotated higher. Do we get another one of those? I would say for now, I don't see anything on the chart making me super excited. The RSI is close to 30, so let's keep an eye. If we get oversold hitting the 200-day, that's a decent counter trend rally type of bet. I wouldn't be disappointed with that as a way of thinking about it. So Micron was up on earnings, right? Closed up about 16% today. It was up more, and it did close below the open. We closed around 12.10, we'll call it. So uptrend, obviously still in great shape. It did not continue further. So you didn't have a lot of, sort of like anecdotally, a lot of additional buyers pushing the price higher. It sort of stalled out for now. The bearish divergence that we talked about yesterday is still very much in play. Semiconductors as a group, the SMH, the SOX, those ETFs are still in primary uptrends. And outside of the big, semiconductor names, NVIDIA and Broadcom, the rest of the space generally looks quite constructive. We're watching those bearish divergences because a lot of the semiconductor names and the SMH have that bearish divergence right now. But for now, the trend is positive. Chevron, which we talked about on yesterday's show, today kind of bouncing off there. Again, it's not enough to give like a bullish candle reversal signal, but it's worth noting this is a confluence of support around 170. And for now, we're seeing a decent bounce off of that level of support. I was looking at Capital One earlier. I had an alert set for if it would break above these levels here around 205, 207. You can see that we broke above Fibonacci resistance. We broke above the 200-day, but then we closed back below both. So I don't consider that a valid breakout unless we can close through that level. So still active, and we'll have to watch it for tomorrow. But there are charts that just look dang good. Merck is one of those. Look at the resistance here, this consistent level around 123. We finally broke above it today, that is. Legendary technical analyst, the late Alan Shaw, would say the broader the base, the higher in space. And one of my mentors, Ralph Akampora, used to love repeating that phrase. So the broader the base, right, the longer we're in one of these sideways moves, the more meaningful a breakout becomes. That's what it means by the broader the base, the higher in space. So Alan somewhere is probably looking at the chart of Merck and smiling. Bill Doan, one of my Fidelity predecessors, was big on big base breakouts as well. Last chart is Trade Technologies, ticker TT. We can see on the chart of Trade Technologies, as I recover the chart like this, another one where we're breaking to a new swing high. Like as a swing trade, I mean, I'm watching this kind of trend channel, and if we get much further, we're going to get kind of to the upper end of that channel. So when we're overbought, maybe that's not the perfect time to buy it. But I think the longer term structure certainly appears pretty constructive here. The fact that the RSI didn't get below 40 in May as we were testing the 50-day, I think is encouraging as well. So there are charts out there that are breaking out. It's just different names that we want to make sure that we follow. All right, let's see what we can answer. Rustin Rogers, thanks for watching, my friend. You said Chaikin money flow is negative on SPY, QQQ, and the diamonds now. Yeah, I actually was looking at that chart earlier. I almost included it, and then I decided not to, but I'm glad you asked about it because it was an honorable mention chart. And we mentioned this probably last week, that the Chaikin money flow is starting to turn negative. The Chaikin money flow, if you're not familiar, basically has a look back period. In this case, we're doing a 21-day Chaikin money flow. So what it's doing is it's looking back at the last month, and it looks at the daily volume reading, and then it looks at where we close versus the high and the low every day. And if we close near the highs of that day, that day's volume is pretty important. If we close near the lows of a day, that day's volume is pretty important and pretty negative. If we close at the midpoint of the day, that day's volume is essentially ignored, right? So it multiplies each day's volume by where we close relative to the range. So it combines price moves with the strength of the move as defined by the volume. And so the Chaikin money flow was very negative in March and April as we were kind of pounding out that low. We rallied off of the late March low. The Chaikin money flow turns positive, gets incredibly positive in April, May, into early June, as we had that big accumulation phase. In June, look over the last month how it switched from pretty positive to pretty negative. That's because we've had these big distribution days. That's because we've had some days where we're closing near the lows, which accentuates the importance of those down closes on heavy volume. So negative Chaikin money flow just implies there's not a lot of accumulation right now. You can tell that, I would argue, just looking at the chart of the S&P, but the Chaikin money flow puts some detail behind that, and I think that's important to remember. Gary Michael Bass, the more or bass, I'm sorry, and please tell me, are we talking bass like fisherman, or are we talking bass like a bass guitar? I'm going to assume bass, or you're a bass singer, and also Gary Michael Bass. Tell me if it's different. The more times you hit a support level, does it become more likely that you will break it? That's actually a really important question. I would say that is not Bass. Okay, there you go. Like the fish or the shoe. Thanks for confirming that, Gary Michael Bass. No, so I would not necessarily say that the more you test support, that the more likely you're going to break it. I guess I would think the number of times you test support suggests or implies the importance of a breakdown, right? So if we do break it, the more times we've tested it, I feel like the break is something even more significant. Now, why is that important? Like the way to think of it, I was taught was once is chance, twice is coincidence, three times is a pattern. All right. This is how I was taught trend lines and support levels, right? So if you have a random support level, we hit it once, like 1 point and a low is not much of a trend. But if then we retest that same level, all right, now we've got a coincidence, right? All right, maybe these are similar levels. But like the third independent time where we test the same point, it's like, okay, now we have a clear level where buyers are coming in. Now we have a repeatable pattern that tells us that we can start expecting that support going forward. But if and when it finally breaks, that tells me whatever was happening back here to cause that bounce is now gone. And either those buyers have all bought, there's some new selling pressure, some new information, but for whatever reason, it's no longer valuable. So that's how I would think about it for sure. Folks, thank you so much for joining me. Sorry for some random little tech issues. My bad, coming to a different place than I normally do it from home, and just messing up the technology one thing after another, like this final shot, which is supposed to be that. So there we go. but I'm glad you hung in for it. Thanks so much. I hope the charts that we talked about and the insights we shared are helpful to you. Hope this helps you make sense of what we saw in the market today. Please take some time to drop some questions in the mailbag. You can do that on the comment section on our YouTube channel. Go USA. The Keller family will be cheering on for sure. I encourage you to do the same. And we'll be back with our mailbag episode tomorrow. In the meantime, have a great night. And remember, it's always a good time to own good charts. Take care, folks.